Solana versus BlackRock. Who's really controlling crypto now? For years, crypto was seen as the ultimate rebellion, a decentralized revolution against the dominance of Wall Street and centralized institutions. Bitcoin was the spark, Ethereum the fire, and then came Solana, blazing its own path with lightning-fast speeds and low fees. Tech innovators, builders, and degens alike rallied around the dream of a truly decentralized future. But now, something has changed. BlackRock, the world's largest asset manager, with over $10 trillion under management, has stepped into the crypto arena. They're not just investing, they're shaping the landscape. From Bitcoin ETFs to quiet influence in major blockchain projects, the question isn't just why they're here, it's what they want to control. And at the center of the storm is Solana. Once hailed as an Ethereum killer, Solana has attracted massive institutional interest. But is that a sign of validation, or the start of quiet corporate capture? Can a protocol born from decentralization survive the gravitational pull of financial giants like BlackRock? In this episode of Money Minded, we pull back the curtain on the growing power struggle between Solana and BlackRock. We'll look at how institutional money is reshaping crypto, whether decentralization still exists, and what it means for the future of blockchain as we know it. If you care about who's really in control of crypto, stay with us. And don't forget to like, subscribe, and share Money Minded, your guide to understanding the deeper forces driving global finance and digital assets. Chapter 1: The Rise of Solana. To understand why Solana is at the center of the crypto power struggle, we need to go back to the beginning, a time when Ethereum was the undisputed king of smart contracts. But cracks were already showing in the armor. By 2020, Ethereum had become the home of DeFi, NFTs, and decentralized apps, but it was also plagued by one major issue: scalability. High gas fees and network congestion made it nearly unusable during periods of high demand. The door was wide open for a new kind of blockchain, one that could offer speed without compromising security. Enter Solana. Launched in March 2020 by Anatoly Yakovenko, a former Qualcomm engineer. Solana wasn't just another blockchain, it was an engineering marvel. Powered by a novel consensus mechanism called proof of history, Solana promised something radical: 65,000 transactions per second. Near zero fees, and sub-second finality. It wasn't just faster than Ethereum, it was exponentially faster. Solana's architecture wasn't only built for speed. It was optimized for the kind of applications that crypto enthusiasts had only dreamed of: real-time trading platforms, scalable DeFi protocols, lightning-fast NFT minting, and even blockchain-based games that could rival traditional online platforms. Developers took notice. Within just a year, Solana's ecosystem exploded. Projects like Serum, Radium, Mango Markets, and Magic Eden began to define what was possible outside of Ethereum. It wasn't long before Solana was attracting serious capital from both retail investors and venture funds. In late 2021, as crypto markets hit all-time highs, Solana's token SOL surged from just a few dollars to over $250. Headlines began calling it the Ethereum killer. Institutional money started flowing in. FTX, then one of the most powerful crypto exchanges, heavily backed the Solana ecosystem, funding dozens of projects and even integrating Solana as a core part of its infrastructure. But this rapid rise came with its own risks. Solana, while technically innovative, wasn't perfect. Its chain suffered multiple outages due to network congestion and spam attacks. Critics pointed out that Solana's validator set was relatively small, raising concerns about centralization. Others noted that a handful of VC funds and early insiders held a large percentage of Sol's token supply. Still, the momentum was undeniable. Solana had become more than a blockchain. It was a movement, one that aimed to challenge the status quo, not just of Ethereum, but of the entire financial system. The goal was clear: bring Web3 to the masses through speed, usability, and a developer-friendly ecosystem. But then came the crash. In 2022, the collapse of FTX shook the entire crypto market, and Solana was one of the hardest-hit projects. With close ties to Sam Bankman-Fried and his empire, investor confidence in Solana plummeted. The price of SOL dropped by over 90%, and many declared the project dead. But Solana didn't die. Instead, it did something rare in the crypto world: it rebuilt. By 2023, a new generation of developers began to emerge on Solana, independent of FTX and its fallen allies. Decentralized apps returned. NFT marketplaces thrived. And perhaps most impressively, Solana Pay and other real-world applications began testing crypto's utility beyond speculation. Retail interest returned, but so did institutional players. And this time, one name stood out among the rest: BlackRock. What was BlackRock doing sniffing around Solana? Why was one of the world's most powerful financial institutions suddenly so interested in a project once written off as damaged goods? Was this a sign that Solana had finally earned mainstream legitimacy, or a warning that Wall Street was moving in to take control? To answer that, we have to understand what BlackRock wants and how it operates. But before we go there, let's pause and appreciate the irony. Solana, born to fight the inefficiencies of centralized systems, now finds itself in a battle for control with some of the most centralized institutions in the world. In the next chapter, we'll explore exactly how BlackRock is entering the crypto space, the moves it's making behind the scenes, and why its growing influence could redefine what decentralization really means in 2025 and beyond. Chapter 2: BlackRock enters the arena. To most people, BlackRock is just a name they see in headlines about stocks, bonds, or the economy. But within financial circles, BlackRock is something much bigger: a titan, managing over $10 trillion in assets, wielding influence over everything from central banks to climate policy. It's not just an asset manager. It's the asset manager. So when BlackRock makes a move, markets listen. Governments listen. And now, so does crypto. In 2023, BlackRock made its boldest move yet in the digital asset world. It filed for a Bitcoin spot ETF, and won. While the crypto community had begged the SEC for years to approve such a product, BlackRock succeeded on its first try. Almost overnight, Bitcoin began to shed its outsider image and gained newfound legitimacy among traditional investors. But that was only the beginning. Behind the scenes, BlackRock had already been laying the foundation for something much bigger. Larry Fink, the company's CEO, went from calling Bitcoin a tool for money laundering to praising it as digital gold. At the same time, BlackRock's Aladdin platform, used by governments and institutions to monitor trillions in financial assets, began integrating blockchain analytics and digital asset data. Translation? BlackRock wasn't just investing in crypto. It was preparing to reshape it. The firm's quiet partnerships with blockchain infrastructure providers, custodians, and DeFi on-ramps pointed to a long-term strategy, not just exposure to crypto, but influence over it. And that brings us back to Solana. While most of the media attention focused on BlackRock's Bitcoin and Ethereum activities, insiders began noticing something curious. Several funds with links to BlackRock were buying up Solana exposure, either directly through SOL or indirectly through Solana-based assets. Rumors swirled about institutional testing of Solana's blockchain for tokenized assets, private equity, and even real-time settlement rails. Why Solana? Because unlike Ethereum, Solana offers speed and low fees at scale, a critical feature for institutions looking to tokenize trillions in traditional assets. Ethereum's Layer 2s and gas fees still pose user experience hurdles. Solana, by contrast, is fast, sleek, and enterprise-ready. But here's the catch. While Solana's technology makes it attractive to institutions, its validator network and funding history raise questions about who really holds the reins. With a more concentrated group of validators and significant early token allocations to VCs, critics argue that it's easier for big players like BlackRock to assert influence, subtly, and without needing full control. This isn't about buying Solana. It's about embedding within it. Consider this: if institutions can shape the future of Solana through early stake, ecosystem investments, and regulatory alignment, they don't need to own the protocol. They can simply ensure it evolves in their image. The strategy is clear: integrate blockchain infrastructure into traditional finance, not the other way around. And BlackRock is leading that charge. But what does this mean for decentralization? At first glance, institutional adoption sounds like a win. More capital, more legitimacy, more users. But the devil is in the details. As traditional financial giants begin shaping governance, funding ecosystems, and influencing developers, the line between decentralization and central planning starts to blur. Crypto was born from the ashes of the 2008 financial crisis, a rejection of the very system BlackRock represents. And yet here we are, watching as that same system inserts itself into the DNA of blockchain technology. Some say this is the inevitable evolution of crypto, from chaos to order, from Wild West to Wall Street. Others warn that it's the beginning of the end, a corporate co-opting of a once revolutionary movement. In truth, the reality is more nuanced. BlackRock isn't trying to kill crypto. It's trying to harness it. And Solana, with its technical edge and market momentum, may be the perfect vehicle. The real question isn't whether BlackRock will invest in Solana. It's whether BlackRock will help define what Solana becomes. So where does that leave us? In a market now driven by both decentralized ideals and institutional ambition. Crypto is entering a new phase, one defined not just by innovation, but by control. And in that tension lies the battle for the soul of Web3. In the next chapter, we'll explore who's really pulling the strings behind the scenes, from validator networks to venture capital, and whether decentralization is still more than just a slogan in the age of trillion-dollar titans. Chapter 3: Who's pulling the strings? In crypto, decentralization is more than a buzzword, it's a promise. A promise that no single party controls the system. No banks. No governments. No Wall Street elites. Just code, consensus, and community. But when we peel back the layers of Solana, and the growing presence of players like BlackRock, what we find is a far more complicated reality. Let's start with the core infrastructure, validators. On paper, Solana has over 1,500 validators running the network. That sounds decentralized. But the truth is, not all validators are created equal. In Solana's consensus model, a small number of highly staked validators process the majority of the transactions. These validators require expensive hardware, fast internet connections, and most importantly, large amounts of SOL to participate meaningfully. This barrier to entry has naturally concentrated power in the hands of those with capital, venture capital firms, early insiders. And yes, potentially institutions with deep pockets. According to on-chain data, the top 20 validators control a disproportionate amount of stake, giving them significant influence over block production and network governance. While Solana Labs argues that the network is still open and permissionless, critics point out that the economic incentives increasingly favor centralized actors. So who exactly are these actors? A closer look reveals familiar names. Early-stage venture firms like Multicoin Capital, Andreessen Horowitz, A16Z, and Jump Crypto hold massive positions in Solana and its ecosystem. Many of these firms were early backers of projects tightly integrated into the Solana stack: liquidity providers, DEXs, oracles, even stablecoins. Now, enter the next layer: custodianship and staking services. Institutional-grade custodians like Coinbase Custody, Anchorage, and even firms aligned with BlackRock provide staking services for SOL. That means large volumes of staked SOL are being managed on behalf of clients who may not even know who they're delegating power to. This is where indirect influence becomes powerful. Imagine BlackRock, through a network of funds, ETFs, and partnerships, gaining delegated exposure to Solana without ever running a validator. It doesn't need to. All it needs is influence over the capital that is staking SOL. This gives institutions an outsized voice in network dynamics without having to publicly own control. But the influence doesn't stop at infrastructure. Let's talk governance and development. While Solana doesn't use a formal on-chain governance model like some DAOs, the direction of the protocol is largely shaped by Solana Labs and the Solana Foundation, two organizations that have historically received significant funding from early investors. These groups guide upgrades, ecosystem grants, and the long-term roadmap. This means that development priorities, what gets built, what gets funded, and who gets support, can be heavily influenced by those who sit close to the funding faucet. And as institutional players become more embedded, the risk is clear. The future of Solana could be optimized for capital, not community. Think about it. If BlackRock or similar firms start funding infrastructure, pushing for regulatory compliance layers, or integrating tokenized securities, the protocol begins to evolve, not based on grassroots demand, but on institutional needs. Permissionless apps give way to KYC protocols. DeFi innovation gives way to regulatory-aligned, safe finance. We've seen this playbook before in the world of open-source software, in early internet protocols, even in the early days of the web. What starts open and decentralized often becomes dominated by the few who provide the funding and infrastructure. So where does that leave the average user? The developers? The idealists? The uncomfortable truth is, decentralization is fragile. It can be designed into the code base, but without economic decentralization, it becomes a facade. When a handful of stakeholders, be they VCs or trillion-dollar institutions, control the stake, the validators, the grant funding, and the narrative, the protocol itself becomes malleable. And Solana may be reaching that tipping point. None of this is to say Solana has failed. In fact, its technical performance is arguably the best in crypto today. TPS, transactions per second, are real. Fees are low. User experience is improving. But technical excellence doesn't guarantee ideological resilience. The question we now face is simple but urgent. Is Solana still a decentralized alternative to traditional finance? Or is it quietly becoming a high-performance blockchain for traditional finance? And if it's the latter, does that make it any less valuable, or simply more honest? In the next and final chapter, we'll explore what this power shift means for the future of crypto. Is it the end of decentralization, or the beginning of a new hybrid era where institutions and blockchains coexist? Because whether we like it or not, the old world isn't just knocking on the door of crypto. It's already inside. Conclusion: the battle for crypto's soul. We began this journey with a simple question. Who's really controlling crypto now? At first glance, the answer seemed to pit two clear players against each other: Solana, the decentralized innovator, and BlackRock, the embodiment of traditional finance. But as we've peeled back the layers, the reality is far more complex. Solana is not the villain. It's a technological marvel, a blockchain capable of doing things few others can. It brought speed, scalability, and a vibrant developer community to crypto. It helped bring DeFi and NFTs to life beyond the limits of Ethereum. And even after the FTX fallout, it rose from the ashes stronger than ever. BlackRock isn't the villain either, at least not in the cartoonish sense. It's playing the game as Wall Street always does, by moving capital, shaping narratives, and embedding itself into any system that looks like the future of finance. Crypto just happens to be that system right now. The real tension isn't between Solana and BlackRock. It's between ideals and incentives. Crypto began as a movement to take power back from centralized institutions. But now those same institutions are here, with deeper pockets, bigger platforms, and more regulatory access than any protocol ever had. They're not just investing in blockchains. They're shaping them. So, what happens next? That depends on us, the builders, investors, developers, and users. If we want crypto to remain decentralized, we have to fight for it. That means supporting diverse validator sets, demanding transparency from foundations, using open-source protocols, and pushing back when power concentrates, even if it comes wrapped in institutional approval. But maybe there's another path. Maybe the future isn't about resisting institutions entirely, but negotiating with them on our terms. Imagine a world where high-performance blockchains like Solana enable real-time settlement for global markets, without compromising decentralization. A world where regulation coexists with innovation, and capital flows into ecosystems built by communities, not just corporations. That future is possible. But it requires vigilance. Because if we don't define the future of crypto, someone else will. And the next time they do, it might not be with code or consensus. It might be with boardrooms and billion-dollar stake pools. So as we move forward, let's not lose sight of the question that started it all. Is crypto still ours? If you found this video insightful, don't forget to like, subscribe, and share Money Minded, where we uncover the real forces shaping global finance and digital innovation. Until next time, stay informed, stay critical, and stay money-minded.